Welcome to this explainer. Today, we're mapping out exactly how the plumbing of our financial system works, starting from the simplest physical IOUs all the way up to the digital currencies of the future. You see, we're not going to look at the global economy as a bunch of abstract math equations. Instead, I want you to picture it as a massive, complex plumbing system, a network of pipes that constantly pumps money, credit, and financial accounts all around the world.
Okay, let's dive into this. Think about the last time you logged into your banking app and looked at your balance. Where did that money actually come from? Did the government print it? Did someone else deposit it right before you borrowed it? Well, your immediate assumptions might just be entirely wrong. Today, we're going to trace those pipes to find the real source of your money. So, here is our roadmap to guide us safely through this ecosystem. First, we'll look at the basic economic ecosystem. Then, enter the commercial banks. Third, how banks create money. Fourth, the central bank backstop. And finally, number 5, the future, digital currency. Let's get into it.
Section 1. The basic economic ecosystem.
To really wrap our heads around the complex plumbing of modern finance, we need to completely strip away all the noise and build our economy from the absolute ground up. Imagine a stripped-down world with just households and businesses. Now, before money existed, we had a really serious problem. If you wanted to trade, you had to figure out, exactly how many chickens equaled one cow. It was incredibly clunky and inefficient. So as early as Aristotle, societies realized they needed a standard way to measure aggregate wealth without complex bartering. They needed what economists call a numeraire, basically a commodity like a specific gold coin used as a universal unit of account. By pricing literally everything in terms of this one gold coin, trade suddenly became vastly simpler. Now, in a modern capitalist system, there is a very distinct division of labor. Households, which is everyday people like you and me, we hold financial claims, things like equity and debt. But the corporate sector, they hold the actual physical assets, the heavy machinery, the sprawling factories, the complex software needed for production. Essentially, households provide the funding, and corporates use that funding to actually build the physical economy. But right here is where we meet the ultimate villain of our story: illiquidity. Imagine a sudden economic shock makes households super nervous. Everyone suddenly demands their cash back from the corporates. But wait, corporate assets are highly specific and totally illiquid. You can't just instantly sell a custom-built aerospace testing machine for full price, right? So when corporates are forced to sell these illiquid assets quickly just to raise cash, they suffer massive fire sale losses. And the end results? Total societal net wealth is just destroyed. Section 2. Enter the commercial banks. So how do we solve that illiquidity problem? Well, the economist Henry Thornton perfectly captured why credit and commercial banking were invented way back in 1802. Credit was basically designed to give merchants the absolute freedom to operate without having to hoard massive, heavy piles of physical cash or gold. It introduced this incredible flexibility into the system, allowing businesses to buy today and pay tomorrow. And this brilliantly illustrates how banks shield the real economy. When a bank sits right in the middle, it acts as a massive shock absorber. If skittish households suddenly get scared and want to hold deposits instead of corporate bonds, the bank just takes in those household deposits and immediately recycles them as credit back to the corporates. The corporates are entirely shielded from the panic. They don't have to fire sale their machinery because the bank is playing the role of the ultimate buffer. Moving on to Section 3, how banks create money. Okay, it is time to bust a massive myth. Most people think banks just take in deposits from savers and then lend that exact same money out to borrowers. But under the credit creation theory, banks literally create money out of nothing when they extend credit. When you go to a bank for a mortgage, they aren't checking the vaults in the back to see if they have enough cash. No way. They just type the loan amount into your account. In that very keystroke, brand new deposit money is born into the economy. Now, you might be wondering, hold on, don't they need actual cash reserves to back that up? Well, yes, but to put that into perspective, look at the required reserve ratio in the euro area. It's just 0.01. That means for every $100 of deposit money a bank creates, they only need to hold one single dollar as actual physical reserves at the central bank. It's an incredibly leveraged system. But hey, before you think banks can just print infinite money, let's look at their constraints. They're heavily limited by the central bank's rules, like collateral haircuts, which basically means the central bank discounts the value of the assets that banks pledge for cash. They're also limited by those reserve requirements we literally just talked about. But actually, most importantly, they are limited by household demand. A bank can't create money if no one wants to take out a loan. Plus, loans come with operational costs and risks that keep the whole system in check.
Section 4. The Central Bank Backstop.
Let's trace the exact plumbing of a modern bank run. Today, bank runs usually aren't people lining up outside in the rain for paper cash. Instead, rumors spark a panic on social media, and households digitally shift their deposits from Bank A to Bank B in seconds. Suddenly, Bank A faces a massive funding gap. Bank B has excess money now, but they are way too scared to lend it back to Bank A. If nothing happens, Bank A goes under. And this is exactly where the ultimate boss, the central bank, steps in to provide emergency credit to Bank A, just to keep the pipes flowing. So the crucial point is this fundamental shift in how the system survives. In normal times, we rely on relative intermediation. That's just banks lending to each other in the interbank market to balance out daily liquidity shifts, while the central bank basically just watches. But in a crisis, trust completely evaporates. We enter absolute intermediation. The central bank has to step in, aggressively expand its own balance sheet, and act as the absolute lender of last resort to save the entire system.
Section 5. The Future. Digital Currency.
So to prevent these volatile, terrifying crises, we're seeing radical macroeconomic proposals gain traction, things like plain money or the famous Chicago Plan. These proposals suggest moving trillions of dollars, like $6 trillion in everyday deposits, entirely out of the hands of commercial banks and directly to the central bank. The main argument here is that if private banks can no longer create deposit money, we could finally prevent those massive recurring financial meltdowns. And this ties directly into why central banks worldwide are actively developing their own digital money, known as central bank digital currencies, or CBDCs. The benefits here are absolutely huge. For you, this means the seamless digital convenience of an app, but with zero commercial bank credit risk. If your commercial bank fails, your CBDC is perfectly safe because it's a direct claim on the central bank itself. Plus, it provides a really stable alternative to wild, volatile cryptocurrencies, and honestly, it's just much cheaper to maintain than physical paper cash.
Now, what's really interesting about this slide is the massive chain reaction this shift would cause. Think about it, if households decide CBDCs are safer and better, they're going to trade in their commercial bank deposits for them. This leads to what economists call disintermediation. Commercial banks would face a massive funding loss, permanently starving them of their deposit base. To keep the economy running, the central bank would have to step in and drastically expand its balance sheet, taking on a much, much larger role in directly funding the economy. Which leaves us with this final, really provocative thought to ponder. For centuries, commercial banks have sat right in the middle of our economic plumbing, recycling our funds and literally creating the money we use every single day. But if tomorrow your digital wallet connects directly to the central bank's pristine, risk-free ledger, do we actually still need those commercial banking middlemen? It's a fascinating question that could completely redefine the future of money. Thank you so much for joining me on this explainer, and keep questioning the systems around you.